Hi everyone, Tommy Lim here from SF Capital, and welcome to another Finance Mythbusters video. Today, I'll be going through another myth commonly held by business owners and entrepreneurs. That is the belief that loans in my business don't impact my personal borrowing capacity. Have you ever taken out a car loan in your business, a commercial property loan, or even a company credit card and thought to yourself, how does this impact my ability to get a home loan? A common mistake held by many business owners is that because these loans are under their business's name and because their business is a separate legal entity, it doesn't impact their personal borrowing capacity. While this might be true in some circumstances, it does not hold in all cases. It really depends on the size and stage of your business, how many shareholders you have, and the bank that you apply to. When determining how a business loan impacts your personal borrowing capacity, there are two approaches. Approach number one is called a group assessment, and approach number two is called a standalone or personal only assessment. Let's first look at a group assessment. This is when the bank combines your business's financial position with your personal financial position to determine your overall borrowing capacity. A group assessment typically applies to smaller businesses, especially when there is a sole owner and director. As we saw in previous videos, for a small business owner, the net income of your business and the salary that you draw are so interconnected that the bank lets you add the net profits of your business to your director's salary to determine your overall servicing income. In other words, the bank is grouping together your income. However, you need to take the good with the bad. Because the bank is giving you a servicing boost by letting you apply your business income to derive your personal borrowing capacity, this means that your business loans also need to be factored in to your personal borrowing assessment. Let's take a look at an example. Say your business generates a net profit before tax of $200,000, and from your business, you pay yourself a director's salary of $100,000. Assume you have no other personal loans today, and the bank is letting you borrow 6 times your income. Your total borrowing capacity is therefore $1.8 million. However, because you are using the $200,000 profit in your business to achieve this borrowing capacity, the bank will also start factoring in your business loans into your servicing assessment. This means any business loans will start taking away from your personal borrowing capacity. For example, $300,000 in business lending may leave you with residual borrowing capacity of $1.5 million. However, what actually happens is because many business loans are shorter term in nature, $300,000 in business lending may equate to much more in home lending, thereby reducing what you can borrow in your personal life even further. Basically, under a group assessment, you can't have your cake and eat it too. So, what's an alternative approach? Under approach 2, a standalone or personal assessment may help you manage the impact of your business loans on your personal borrowing capacity. This approach applies more to larger and more mature businesses, especially businesses with multiple shareholders and directors. This approach may also require some forward planning in terms of how you draw your income from your business, whether by dividends or salary, and also may require you to approach a bank that will view your income in this way. In a standalone assessment, this is when the bank does draw a line between you and your business, but only does so under certain conditions. The first is that you are drawing out enough income from your business within a financial year to meet your desired borrowing capacity. The second is that your business is profitable and you are leaving enough cash in your business to meet its ongoing commitments. Under this approach, the bank may still require you to provide your financial statements to prove that you are profitable, or at the very least, provide an accountant's letter confirming that your business is trading profitably. Going back to our example, assume you've now decreased your business's profits to $100,000 and increased your salary instead to $200,000. Based on a 6 times debt capacity, the bank may lend you up to $1.2 million on this salary. If this loan amount is sufficient to meet your personal borrowing goals, and the $100,000 profit left in your company is enough to service your business debts, then the bank is more willing to draw a line between you and your company and exclude your business loans from your personal servicing assessment. When this happens, Your personal borrowing capacity is not impacted by your business debts, and the derived borrowing capacity is yours to keep. This approach may also be helpful if the loans within your business are very complex, or your other shareholders are unwilling to share your company's financial statements with third parties. So we've now looked at two ways that the bank evaluates your borrowing capacity when you have business loans in place. The first is a group assessment, and the second is a standalone assessment. I hope this debunks the myth, the loans in my company don't impact my personal borrowing capacity. If you have any questions, feel free to drop them in the comments below, and I look forward to seeing you in the next video.